Hello, everybody. Welcome to our new properties webinar. We've released 6 new properties yesterday, and we're joined by Cameron today. So excited to get things started. Before we do, to give folks a few more minutes here, or a few more seconds, would love to hear where you all are tuning in from. It's raining in Seattle. It's feeling very cozy over here, ready for Halloween, that's for sure. Cameron, how is it in your neck of the woods today?
It is very similar as we are both in the Pacific Northwest. It is raining, and it'll probably rain on Halloween, but I'm taking my kids to an indoor thing anyway, so we're good.
It's the way to go. Us Seattleites, we have to pivot quickly. It's like, ain't no thing with the rain.
Yeah, the whole
Look,
summertime, it didn't rain, for, I don't know, 3 months. And then now it's going to rain for 3 months.
yeah, I know in a few months, Cameron will be like, please, can we go to Arizona?
Yeah.
One of our rentals. So looks like we have folks in from Katy, Texas, San Diego, Houston,
Nice.
Richmond, Stafford, Richmond, Connecticut. Oh, James or Nancy, good to see y'all again.
All right, James or Nancy.
We love it.
Yeah, we love
Chicago.
James or Nancy.
We definitely do. It's good to see some familiar faces in here. Makes this more fun. Steven said they've got some sunshine today, but they'll be growing some oranges soon. Shoot,
Nice.
fresh OJ sounds good. Cameron, that leads me. What are you sipping on today?
So today I've got spiced apple Waterloo. This, I didn't like it at first, but Waterloo is the king brand of just that like perfume essence and things. And it's growing on me, and it kind of tastes like potpourri at first, but in a nice way. So it's very fall timey.
I love it. Very on brand. And it's just Jim today, not Nancy. Good to know. West Palm, Brian, good to have you. Well, we'll go ahead and walk through brief intros, even though you all know Cameron Wu, our VP of Investments. Again, my name is Corinne Headland. I lead our investor relations team here at Arrive. We'll walk through a brief agenda because we did add more details to this just to add more context. So first and foremost, Cameron will be walking through high-level asset differentiation. So for those folks that are new here, this will be the difference between long-term rentals and vacation rentals, the operating model, overall investment thesis, and then those 6 new properties that we launched on our website yesterday. So after that, we'll go through a live Q&A. I'll be dropping answers to your questions in the chat, but if there's any that perhaps need more color around the 6 properties, we can definitely get to them. We'll try and keep the questions for this webinar to those property specific pieces today, as we do have another standard webinar at 1 p.m. PST. So Cameron, I'll see you again later this afternoon, but Cameron's going to take it from here, folks. Keep us honest in the chat if there's any questions. When's the wedding? I got married last Friday, actually. So married woman, and thank you so much for asking. We got married on the Oregon coast, right on the beach. So it was absolutely phenomenal. So, all right, Cameron, I'm going to kick it over to you, and I'll be back.
All right. Thank you all so much for attending. And for today's webinar, we thought it was timely to really talk about our 2 different investment products at a high level. For those of you who have been with us for a while, Arrived initially offered long-term rentals and single-family residential, so your standard, rental home business model. And we quickly expanded into now vacation rentals. So, in the spirit of trying to make sure that we all understand the investment profile, the assets that go into each different product type, that's really the purpose of this webinar. And then we have 6 properties launching that for the first time, we have both vacation rentals and long-term rentals on the site simultaneously. So here we are to really help our investors understand the differences between the 2, so you know what you're getting into as you look at each investment product. All right. So just some really high level stuff first. A long-term rental versus vacation rental. They both use residential assets, and it could be a single family home, it could be a townhome, it could be a condo, apartment, etc. There are some other limitations as far as how you can use different assets, but both effectively do use residential assets. Now, let's talk about some of the differences in long-term rentals now. It's considered core housing, right? So when you are thinking about where do I live every day, that's what we mean by core housing. And that is the long-term rental business model. It's a very mature and seasoned industry. So there are large companies, there are economies of scale, there are vertically integrated operations. So it is just much more seasoned and developed in all senses of the word. Price competition, cheaper management rates. Um, there's innovation, of course. It's an old business, but it's been around for a long time. The landlord tenant business and the surrounding uh, components to help with that, they've been around. And there's low operational complexity. It is generally seen as a more passive investment because of the lease structure, right? You get a tenant in there, they stay 1 year, 2 years, maybe even longer, sometimes shorter. But for an income producing asset, it is definitely much more on the passive end of the spectrum, even though there are some significant operational challenges and hurdles at various points in time, especially during the vacancy period. We know when you don't have a tenant in there, it gets a little bit complicated, but overall, we know what we're dealing with in terms of the stability of the model. Now, with vacation rentals, this is a newer asset class, right? So it's for vacation, it's leisure, it's temporary housing. So we're more talking about vacation rentals in our initial launch of this investment product, but it can also be thought of more generally as short-term rentals, whether it be a month, 2 months, 2 weeks. Those are also example stays where it may not always be for vacation. It could be for business travel. It could be for other temporary accommodations, insurance, having a business arrangement with an insurance agency as a way to get temporary stays, for example. Not saying that we would go in that model, but just trying to illustrate different flavors of conceptually a short-term rental, right? And a vacation rental, is a asset segment that we choose to be in for the reasons that I'll go into quickly. And it's new, it's changing, it's growing. This is such a recent industry and it's exciting. So there's a lot of opportunity. There's a lot of investment opportunities as well as service opportunities. And it's higher operational complexity. So a vacation rental is your standard Airbnb. They are 3-night stays. There's people in and out. So there does end up being a lot more on the management side of things, which can lead to higher revenues, higher opportunities, but also increased costs. And we're going to go through all of those trade-offs now. So the asset types, when we think about investment products, it's really the component, the component is two things. The first is an asset type, and the next is an operational model, which we'll go into next. But for the asset types, let's look at long-term rentals first. We're usually thinking about suburban neighborhoods, and we could also be talking about multifamily, so duplexes, triplexes, fourplexes, and also 8 to 20 unit apartment buildings, 30 unit apartment buildings, et cetera. But, primarily we've been in the single family residential space, and assets used like that, such as townhomes. They typically fall in a range of 2 to 5 bedrooms, 2 to 4 bathrooms, and kind of importantly, 1,000 to 3,500 square feet, really on the upper end, but your bread and butter long-term rental assets are probably 1,800 square feet for a 4-bedroom, 1,500 or 1,600 square feet for a 3-bedroom, and maybe your average is 1,900 or 2,000 square feet for your portfolio. Long-term rentals, you go for clean, safe, functional, but they're going to be a little bit cookie cutter, and you want stability, right? This is housing for the majority of people. So you want something that a lot of people can, have a high demand for. So a 3 and a 4-bedroom house tend to be the sweet spots where we find the best investment opportunity, where you get the best rents relative to how much you have to pay to get into that asset. And then core markets, really, we're looking for long-term rentals that have good economic thesis and population dynamics underlying it. So you might consider your top 50 metros as like the prime breeding grounds of where you would deploy a long-term rental model. But there's also areas of opportunity where you invest ahead of where the curve is. So maybe there's a market right now that is number 150 in terms of the population of the MSA, but it's growing and it's strategically located and there's a real economic thesis behind it. Those are also the markets that you want to get into. And that's what I mean by it's deployable anywhere, because a lot of services, the software services, cloud services, they really allow you to manage remotely in today's environment. That really wasn't possible 20 years ago. So core markets, our portfolio consists of larger population centers, but it is deployable anywhere. Now with vacation rentals, you have various residential, so you can really put this, you can buy any kind of residential asset as long as you can get it permitted. And that's one of the big constraints that we'll talk about in the operating model. But lots of asset profiles work, right? So you can find the right niche for many different needs with a lot of different asset types. So I think that this is unique about vacation rentals in that a lot of things work. It's unique, it's more experiential, and we kind of look for more land a lot of the time. So that's something that is not common with long-term rentals, is looking for land. And they tend to be in smaller markets. So you don't often have tons of vacation rentals in your core, top 10 markets, because people are not vacationing. That's where they live and they work. They're looking to go somewhere else. So it's a lot of third and second tier type markets in terms of population centers that end up being popular vacation destinations. And next on the operating model. So this is the part where, how do you make money as an investment now? What are the cash flow components? Because we just talked about the asset types. So on a long-term rental, you have a lease. It's 1 to 2 years. There's lower initial investment because you're not providing furnishings. It's empty, right? And you're in a space where your purchase price represents a lot of the investment. They are scalable assets and operations. So when I mean scalable, is that we can deploy a plan where we acquire 100 assets, 200 assets at a time. And because they follow the same more homogeneous pattern of operations, in the sense of like getting it to a standard of readiness and what kind of assets you buy and with the channels you market in and how you price them, there's a lot of homogeneity in how you deploy that operating model. So when there's more homogeneity, it's very scalable, and just real quickly, think about a Coca-Cola bottling factory. It's just like, that's a highly scalable operation because that factory just pumps out so many bottles of Coca-Cola through a conveyor belt process. So, you can kind of analogize that in your head as like, hey, what is a long-term rental model? And it's that scalability piece, right? Because you can deploy that operating model very modularly. And there's lower volatility of cash flow. That really goes to the idea that this is core housing. This is something that people need. And when we're talking about occupancy rates, we're at 95%, 96%, in the 90s, as far as asset utilization. So these are things that people need. So it's much more stable. And that's what I mean by lower volatility. And you have leases, you have 1 year and 2 year commitments to living in a place. So that's the nature and the flavor of the long-term model. And then on the vacation model, you have rental agreements. So when you go and make a reservation on Airbnb, you sign an agreement to stay for 3 or 5 nights. It's not effectively the same thing as a lease in terms of legal ramifications too, because with a lease, it brings in the whole body of landlord-tenant law that each state and municipality have dominion over. With a rental agreement, it's much more like a business arrangement, much like a hotel stay. Like you go to a Marriott, you have a rental agreement for 1 night, 2 night stays. There's a high initial investment for vacation rentals. There are larger assets that you can invest in, and there is also furnishings that you have to provide. There are experiences that people expect when they go stay in one, that the utilities always have to be on. There's cable, there's internet, there's sound systems, there's, whatever people are expecting in a vacation stay, right? So all those types of things are initial investments that go into that, calculus of like, okay, how much do we have to invest up front? It's less scalable. The operations are much more in and out. If you want to scale something like 1 night stays, it's already called a hotel, but those have limitations in terms of there's experiences. So it's less scalable kind of by design, but you'll see in our thesis that kind of it reinforces what we're doing in terms of which assets we're looking for, uniqueness. Higher volatility of cash flow. So some vacation rentals are seasonal. Some areas are naturally seasonal. Think about a ski resort, right? That's going to be 4 months, 5 months out of the year that you can utilize it. Hopefully it's got a good summertime accommodation too, with like lakes, maybe like Lake Tahoe. But, naturally there's going to be an ebb and flow of vacations of when people are able to do it. It's going to skew towards weekends. It's going to skew towards holidays, and it may skew towards our conception of seasons, right? Fall, winter, summer, spring. So those are the dynamics of the operating model within vacation rental. So how does Arrive kind of all synthesize this and think about long-term versus vacation rentals, and how do we put this plan into action of what we buy? Okay, so for long-term rentals, let's go through this vertical. We want to try to be near construction costs, right? That's like the kind of conceptually rock bottom price that you're getting in at, is how much did it cost to build, how much was the land. Now we're not going to be there. Hopefully we can get to that point, but when you're buying properties on the market, you're not there, but you want to try to be near there because that protects you against the downside. Invest in lower price points. So this is a little bit more timing specific, because you can definitely have a successful long-term rental model investing in more expensive assets. In fact, I would say that some of what we offer does fit into that bucket, but with interest rates increasing, we're finding that lower price points offer better income yield and more downside protection. So that's how we've adjusted our investment thesis. Stay close to infrastructure. This is always paramount for us, because as we're thinking about commodity housing with long-term rentals and like that core housing, we got to be close to convenience, we got to be close to jobs, and we just have to make all of that work. Excuse me, my power cable was not in. Okay. Balance cash flow, so versus appreciation. So with long-term rentals, we get pretty strong rental, stable rental income. But then with appreciation, that's a big component of the long-term rental thesis. So, we're targeting an even mix of both. We could go straight to, appreciation plays, and that might be more expensive properties.
It looks like we might have lost Cameron for a brief moment. It might have been just before he plugged in his power cord to his computer. So we'll give him a moment here to hop back on. But essentially, Cameron is going to walk through the differences for the investment thesis for both of these asset classes and speak to it. He did get bumped off there, Mike, so he will be back shortly here. In the meantime, though, if there's any questions that you all have, I mentioned this earlier, feel free to flow them in the chat. We're happy to answer them. And it looks like Cameron's back in action. I'll just stay on the line.
Yeah, you know what it was? The power cable from the wall to the charger pack was just like so slightly
No,
loose.
we're good to go.
Sorry, annoying problem to have. Okay, great. So getting to vacation rentals in terms of the uniqueness of the asset, right? What's interesting about vacation rentals is that with larger assets, you can get commensurately higher revenue. And this is usually not the case with real estate investments. The larger a house and the more bedrooms it has, the price per square foot tends to be lower. Think about it like buying something at Costco or Sam's Club. It's that you buy in volume and the unit price goes down. With vacation rentals, we find that it's positioned where that phenomenon does not affect it quite as much, because you think about a vacation rental as a big group gathering, family reunion, something like that. People need a really cool accommodation to host a large number of people in a condensed spot with unique features. A hotel can't offer that, and there's really very few places that are suitable to that. So the amount of revenue that you can charge is actually, kind of scales linearly with the size. But when we buy the assets, you can actually get discounts, right? Because as you buy more expensive assets and larger homes, the unit price on buying it goes down. But when we try to get revenue out of it, you can charge higher revenue because that's what people need. So anyway, that's why it's not intuitive. It's like the bigger, the better. But that's what we mean, is that the revenue scales with size, which is very odd with real estate. Third, be drivable to population centers. This is core because you got to be able to make sure that it's at a place that's accessible to people. It can't be too hard to reach, right? Hawaii and Alaska are like awesome places to go when they're accessible, but we saw during the pandemic, if you can't get there, like you get obliterated in terms of being able to monetize those assets, right? They weren't allowing people in, more or less. So at least in Hawaii, not Alaska, but at any rate, being drivable to those population centers, that helps you stay in a defensive position to make sure that there's always a source of business coming to your investments. And the fourth part, maximize revenue. This really goes in with investing uniqueness, and the bigger the better. But with vacation rentals, it's really about getting how do I get top 5 percentile revenue? How do I get that really high slice premium experience? Because that's where there is opportunity in the market. And that's the space that we've chosen to invest in for vacation rentals. So that's an overview of the Arrive investment thesis for like two investment products, long-term rentals and then vacation rentals being, using the same assets, but having a different very operating model. And thus you get a very different investment thesis of like what we choose to purchase. Next, so those new properties, what do they look like? And just want to go through 3 of the short-term rentals and 3 of the long-term rentals that we have on the site right now. So the first one is the Serenity. It's in Sedona, Arizona, which is a new market for us. The management company is Old Town Rental, and they are one of the premier short-term rental managers in the state of Arizona. So we're expanding with them quite nicely in Scottsdale, in Glendale, and now in Sedona, Arizona as well. It is currently going through the furnishing and rehab process, and we expect it to be ready in January 2023 for bookings. The next one is Sugar Creek in Blue Ridge, Georgia. So this is our second home being offered. And similarly, the same management company, Southern Comfort Cabin Rentals. We actually had a webinar with Bob, who is the manager of operations with that company. And you should check that one out. It is under contract, but it will be closing in the next 10 to 14 days, I believe. We're past the due diligence process. So we've already got the ops going behind the background to get the design ready, get the furnishings ordered, et cetera, et cetera. So the commitment is there. And similarly, expecting bookings by January 2023. And the Palm in West Palm Beach, Florida. I think we had some folks from Palm Beach area. So Rosea's Hospitality, they're one of the largest Florida-based short-term rental management companies. We are under contract. Similarly, we've got about a 2-week closing period. So look for that in January 2023. And the next 3 are our long-term rental assets. So the first one is in Tuscaloosa, Alabama, the Mimosa. This is a great market. It's where University of Alabama is. 2016 build, 3-bedroom, 2-bath, 1419 square feet. It is on the market ready, and we're pretty hopeful about it. And this is kind of consistent with our thesis of what we just said about newer construction, lower price points. So this is an asset that we expect to always be in demand. It's at a great price point at $14.95. It's at a size that's very accessible to a lot of different household configurations. So great investment there as far as being in Tuscaloosa. It's a market we like. The Redondo. So this is exciting. Albuquerque, New Mexico. This is a new market for us, and we've got 2, as you'll see on the next one. This is a 2013 build, 3-bedroom, 3 full baths, 1882 square feet. It is under contract and will be closing in 2 weeks. The Sundance in Los Lunas, New Mexico. I believe that's also a suburb of Albuquerque. 2008 build, 4-bedroom, 3-bath, 2489 square feet. And we have closed on this one, so it's currently going through renovations. There's a lot more detail on the invest page. You'll see everything about the offering, the fees, the historical return profile, et cetera, for the market and the properties. So with that, thanks for attending. Hope for some great Q&A. Sorry about the little technical glitch, but
Definitely.
ready to
Cameron, thank you so much for walking through the differentiation, both the asset classes. Obviously, there's a lot to unpack there. So walking through that's always beneficial, as well as high-level overview. I think on social, our team called this a mega launch, and it definitely felt like that with 3 from each asset class. Personally, I was so excited about our Sedona property that launched. I think it's like 10 minutes from trails. If for anybody that has been to Sedona, you can pop around in all those trails really easily. I think there's a hot tub at that location. 11 out of 10 cannot wait to go there. So very excited for that one. I did see a question flow in from Mike. So for vacation rental investment thesis, is not a hotel substitute and more premium splurge? How are you seeing demand for that given historic inflation and COLA investment returns not keeping up?
Yeah, yep, that's a great question. So with a higher end luxury space, it is intuitive to think that during recessionary risk or recessionary times that demand would be, at risk on those. And I think that's probably true, right? So what level of luxury are we talking about? I think that even at the tier that we're in, there are significantly higher tiers of experiences. You can think about 3, 4, $5 million assets. Most of the homes that we are purchasing are in the range of 600,000 to about $1.1 million, and on that upper range, we're definitely negotiating on the order of six-figure discounts. So like we're building in equity on those purchases to kind of hedge. But your question specifically about traveler demand and vacation rental demand on those upper end markets, it still remains to be seen because we're rolling out our first assets. But the first one that we had, which was the Oasis in Nashville, Tennessee, the first week it was available, it got booked for many of the weekends over the next 3 months within the first week. So it's at a price point that's not out of reach. So I can't comment to the highest price points, but with our daily nightly stays, we're still finding that on $1 million assets that demand is still there.
Definitely.
For groups.
I wanted to take a step back too. I know, Cameron, you had walked through essentially those different, for long-term rentals, like phases that they can be through. So for everybody on the line, just so you know, we just updated rental status. It lives under the tenant leasing process. We had a ton of feedback from investors wanting to understand from the point in which an investor invests in a property, how long until it's rented or what that looks like. So we've added quite a few different stages in there. So that's what Cameron was referencing. So if you do take a peek at those, you can hover over that rental status and it'll populate for you to give you more visibility into that. So wanted to quickly mention that. I see quite a few more great questions flowing in. There's one from Tim, and Cameron, you lightly touched on this when you were talking about Hawaii and Alaska, but do you see the vacation rental, like in terms of politics, do you find that tricky?
Yeah, and I would say it's more the regulatory landscape, and maybe the political landscape can be referenced to certain hotbed markets like Napa Valley, for example, where there's very much a sense of wanting to keep the residential integrity and character of the area that they live in and not turn it into a vacation rental market. So I think some of it is definitely political, but mostly what we face as we're expanding in markets and locations is more what I would call municipality and regulatory, just that navigation of that code. So how it got there, maybe that's the political part of it, but the reality of what we deal with is much more on constraints of whether we as a non-owner occupant investor can invest, right? So that's the layers that we have to navigate. But yes, that part of it is especially tricky as well, because you do have both state and municipal law intersecting. As a real quick example, Charleston, South Carolina is an excellent example, because there's about, I don't know, 10 blocks or so of this like half-mile radius where non-owner occupant investors can own vacation rentals. Otherwise, you have to be an owner occupant. So, you can always lease out a part of your house or something like that, for the most part. But if you don't live there, that's when it gets tricky. And that's our scenario. And that's
definitely. And Cameron, for those 3 vacation rentals that we released yesterday, Tim was saying, like, in terms of acquiring those, did we face any like regulation issues when acquiring those properties?
No, not for those properties, because we made sure that the market would allow for it. So we work with different sets of property managers and brokerage that vet this before we commit to an offer. Now, we may put something under contract, but if we find that it's onerous or may not work, we're going to pull out of it before due diligence. And we don't offer it on the platform until we know we're going to buy it, right? Like we've passed that due diligence period. So no, fortunately, no problems yet. Fingers crossed. It does get tricky, but so far so good by making sure the diligence is up front on the market.
Tim gave an example of Big Bear being a tough one. So I appreciate you sharing that. Mike, I know you asked about any more Easter eggs in the future. For anybody on the line that's new we released 3 properties previously that had baked in appreciation. So if that's something that you like to see, definitely give us a thumbs up. We might have more of those in the future, but we're always interested in what you're looking for and the why behind it, so we can provide you with what you want to see. So I'm already seeing a thumbs up in here. Love to see it. There was another one in here from Solomon. Can we talk through an example and try to estimate revenue and rental yield for a vacation rental versus a long-term rental? 25% of gross rental as management fee can be significant.
Oh yeah, definitely. So here's the back of the napkin math that we can do to kind of estimate this. And it employs 2 concepts. One is called a gross yield, and then the other one is called a net yield. So a gross yield is just your total collected rents, or not collected, but total potential rents divided by your purchase price in a yearly basis. So an example of that would be if you collect $5,000 of cash flow on a $100,000 investment, you have a gross yield of 5%. Now, what the net yield is when you factor out expenses. So you got to pay for things, tax, insurance, all sorts of property related expenses and ownership expenses as well. So for vacation rentals, what we generally find in the market is that gross yields are about 12 to 15%. So let's think about $1 million property real quick. We would estimate gross revenues of 120 to 150K of revenue coming in per year. Now, the important part though is the net. So right now we are estimating that operating expenses are about 50% of every dollar collected. So if you are at a 12 to 15% gross yield, then you would be looking at half of that for the net yield. So 6 to 7.5, somewhere in that range. Okay, so that's vacation rentals. Now, long-term rentals, this is going to be a more conservative play. Now, income can't quite stretch as high, right? And it's less volatile, but we find that cap rates, or I'm sorry, gross yields are in the neighborhood of 7 to 9%, depending on the market and purchase price point. The cap rates, which is kind of the very standard term for measuring your returns in a cash flow sense, they end up being about 60% to 65% of those gross rates. So if you're at 8%, for example, you would say 60% of that is going to be my net yield, because about 40% of that is expenses. So I'm keeping 60 cents of every dollar that I collect in rent. So that would be a 4.8% net yield. Now we're talking about cash flow here, just to be clear. We're not even factoring in appreciation, asset growth, tax consequences, depreciation. None of that's what we're talking about. We're talking purely about revenue collected and then the expense to collect that revenue. 50% for vacation rentals, 60 to 65% for long-term rentals, and then, higher cash flow. So, that's kind of the rule of that. That's how we try to articulate a rule of thumb and back of the napkin math as a tool to help you think about investment cash flow.
Yeah. Thanks for walking through it, Cameron. I know we could spend hours at a coffee shop doing back of the napkin math. So appreciate it. I also dropped a link to our help article. It's How Does Rive Make Money? But it walks through our sourcing fee, our AUM fee, assets under management, and then the differences for long-term versus vacation rental. So I know some of these will, if you click on them, it'll take you out of the webinar. So if you aren't able to get to it now, feel free to ping us, support@arrivedhomes.com, or you can also use the little chat widget in the bottom right-hand corner of our platform. So don't want you all to miss out. Thanks.
Yeah, it's an annoying feature that it doesn't default to opening it in a new tab, right? But if you do right click it, you can have the option of doing it. It's just like, I wouldn't think to do it because it's like, you just click on it and it's kind of not user friendly.
Yeah, we don't want that. Also, I think we have quite a few folks on mobile too, which is even more difficult. So yeah. Anyways, there was one from Mike in here. I know I answered it briefly. What's the estimated holding time for vacation rentals? So that was the first one. And then expecting appreciation on those as well, or just focusing on the cash flow?
Yep. Great question. So part one, time horizon on the investment. That is anticipated at 5 to 15 years. 5 years as a minimum hold period, very similar to our long-term rentals, the very first income products that we had, in the sense that these are residential, and anytime you transact residential real estate, you're going to have transaction costs. Historically, we've had strong appreciation in the residential asset class, so you want to hold it for a longer period of time just to make sure that plays into the thesis. But even if there's a gain, you want to just be careful about not selling too quickly, because you're going to have to transact that in the real world and pay anywhere from 6 to 8% on closing costs, right? So we want to make sure there's a healthy enough appreciation. So you're anticipating holding it at least 5 years, get the cash flow in the meantime. And then why the 15 years, right? So that can be a longer period of time. And these are anticipated to be stronger income producing assets. So when you think about what does it take to get an income producing asset, it's a higher investment up front. We got to pay for furnishings. We got to pay for unique experiences and themed items that, are not cheap. They're not your Moen faucet at Home Depot. They are like sometimes custom pieces that are part of the design. So making that investment, like, you need an appropriate period of time to get paid back on the cash flow. Like a couch, the minute that you buy it, it becomes used, right? So when we buy these furnishings, for retail value or some kind of bulk discount, but new value, the minute that we buy it, it depreciates. It's just what happens. So the furnishings are automatically less valuable than, say, real estate, which, like, the great thing about real estate is you buy it, you use it, and over time it actually does go up in value. So it's like it doesn't depreciate, which is the unique thing about it. And with real property, it's like, well, what's the best way to make use out of it? Well, if we hold it a longer period of time, my sofa in 10 years, yeah, it's going to be a little bit beat up. But if I bought a good one, then it should be the same sofa I bought, day one. And we're going to generate income off of that. So that's why we want to hold it for a longer period of time. The second part of the question, could you help me
expecting appreciation on those as well, or just focusing on cash flow? It's a great question.
Yes. Yep. And the great part about the model is that we're using residential assets, and, we look at vacation rentals as a two-part, like two-pronged attack. One is on the income side, right? Because one of the investment theses were maximize revenue. Like, we want to get super awesome income producers. But on the other hand, they are residential assets, and we need to be in a defensive mindset, right? We need to say, make sure that we're not overpaying for the asset itself. These are more expensive assets. Where can we find discounts? So yes, we do expect appreciation in this segment as well, because it is just a different slice of the same underlying assets that support long-term rentals, which are residential. So if you're bullish on the prospects of residential asset class in the United States, then short-term rentals is a good utilization play. Think about it more like that you are investing in residential assets in a long-term fashion, but you're making a higher utilization income play than making it a long-term rental. Like, if I buy $1 million house and I try to get a long-term tenant in there, there's not too many people in the market, or like, who are capable of paying $7,000 a month in rent. That's just really high. And there's a very thin market for that kind of demand, that kind of price point on a long-term rental, right? Most people are going to buy their house at that. And with short-term rentals, $1 million, like, that's an approachable asset when, like, 12 people are kind of group funding a vacation together. Like, they can afford to use that $1 million asset, and in return, we get the income for it. So that's like the plays that, yes, we're expecting appreciation on it, just like we're expecting appreciation on our long-term rentals. We're just trying to utilize the real estate in a better way.
And I think it's interesting as you're walking through it. I know Mike mentioned, since vacation rentals are being designed as unique vacation experiences, right? Which is why we've chosen those property managers to fully, like, design and make them a great place for bachelorette parties, so on and so forth. Selling it to average home buyer might be difficult. So curious what your thoughts are too on that, Cameron. That's from Mike in the chat.
On the home buyer's ability to compete in this space with vacation rentals, was that?
I think it's like upon sale. So after that 5 to 15 years, let's say we have, I'm thinking of like the the Palm or the Oasis, like it's very branded, and then selling that back. If I'm understanding you correctly, Mike, like keep me honest here. Okay, correct, Corinne. That it could be difficult to sell to like an average home buyer after that.
Yeah. Yes, understood now. I do not know if like to what extent the furnishings will retain their value in some level of appeal. But here's what I do believe is that over time, so 10 years, 15 years, the vacation rental market is going to become much more institutionalized and competed away. Right? There are some really healthy potential gains that we're seeing in the market, and just some really interesting business models out there that allow for more monetization of assets. And you know, smart money is going to find this, and it's much like the long-term rental business. It's going to become institutionalized. There's going to be much more investment into it, which is great because it produces a better product and a better experience. Like renting long-term rentals today is so much more transparent and accessible than like 40 years ago. It's insane how different it is. So this is a good thing that's happening, but it's going to be that there may be more of a market for selling vacation rentals. It's a very loose, thin, not transparent market right now as far as like reselling vacation rentals. And there's not too much of a market for it because a lot of individual owners, they're not capable of buying $1.2 million assets that are already furnished. So like the price point is already inaccessible for your average investors for the most part. But then as companies quickly get into the business and see the same opportunity of residential assets with a higher utilization income play, money's going to pile in. Like we see it happening, that there's more investment into it, and thus it's the nature of competition. So it's going to build up, and there may be an exit market for us, and that is a very realistic exit plan for these short-term rentals, is to sell it to another income operator over time. If we get it at today's rates and got to utilize it for a long time, maybe the built-in gain is that rates go down and somebody's willing to pay more for it, for that income stream it's capable of producing. So, loud and clear on that at a higher price point, it's harder. There's a thinner market today for sure. If you try to sell a $250,000 home, there's so many people who are willing and able to buy a $250,000 home compared to $1 million home. So, agreed 100% on the difference in the kind of the exit plan in the future. But I'm almost certain that there will be a much more robust environment in the future.
Definitely. And I like this. There's quite a few questions, but Mike said, is it once a VR, always a VR? Once a vacation, always a vacation rental? I know we've talked about this, Cameron, about converting. What are your thoughts here?
That is a super good question. And it really starts demonstrating the operational sophistication and complexity that we can start like building into the plan. So like we do underwrite our short-term rentals with like a long-term rental value in mind too, because what we think about is downside protection. What happens if in a short-term rental that we're in, a vacation rental we're in today that we fully got permitted, at some point in the future the regs go against us and we can't operate it anymore? That's possible. What's the market like for a long-term rental? So we do think about that and kind of position it differently, but not all assets are going to be conducive to that, and there is some risk involved. If I'm being completely transparent, because you're taking bigger swings at more unique assets. So we do think about the viability of a short-term rental as a long-term rental and vice versa. But there's not a super strong overlap between the two because we're dealing with like higher price point assets with our vacation rentals. Now, as I alluded to earlier, though, in the webinar, there's an idea of short-term rentals. So a short-term rental is not necessarily a vacation rental. It may be a one-bedroom furnished office suite right by like Bank of America's headquarters in Charlotte. Or like so it could be something like that. That is another short-term rental play that's different. And it would be similar to what we do today in terms of furnishing, active management, things like that. So a lot of potential here, but I generally think about it as, how do you utilize an asset for income and having flexibility between that?
We have a real estate agent in the house. Steven's here. They're a realtor in New Jersey and they work the entire state. We don't currently have any assets in New Jersey. But Stephen, if there's a market in particular you're interested in, I would love to hear it. Cameron, before we get to the next question, what are your thoughts on New Jersey as a whole before we dive in here?
Huge population center. I personally don't know a ton about it, but we actually have employees there who are real estate investors. So we know that there's a game there to be played. There's tons of people there. It may be the beneficiary of a similar thesis too. Maybe people leave New York City and parts of New Jersey, are on the rise. So conceptually, just love the idea, but we just haven't found the right way.
I did drop a collaboration link. So in here, like Stephen, if that's of interest to you, definitely let us know. We would love to hear from you. I know Mike mentioned short-term office space could be huge, especially with remote work environment. Cameron, I know we talk asset classes like up and down all day, from parking garages to vacant land to farmland. So I'd love to hear that, Mike. There's a great question in here too from Manik, and my apologies if I pronounce your name wrong. How are you factoring high rates and inflation in negotiating prices on properties? This is a phenomenal question.
Yep. It is shifting to more of a buyer's market, right? Because many buyers are dropping out of the race, because the mortgage rates are not allowing them to, purchase what they want. So as far as factoring in rates to get the best deals, we find that we're in a stronger negotiation position for certain asset classes, but not all. There are certain asset classes that are still very much in high demand. And even in this month, you're going to see month over month price growth, meaning that home sales this month on average might be higher than a prior month in terms of like median price. So not all markets are falling, not all price points are falling. So the market does not act uniformly. I'll tell you where we are getting discounts, like significant discounts. It's on the high end of the market. And this factors directly, the reasoning, the rationale why it directly addresses your question about like interest rates. So the high end of the market suffers more than the low end of the market, especially with interest rates, because purchase prices are higher. You're dealing with jumbo rate mortgages as well, which typically are going to require a 20% down payment. So a 20% down payment on $1 million home is not an easy $200K down payment to come up with. So a lot of people are dropping, out of the market, and their payments don't go as far as they used to because the interest rate is higher now. So we are still a cash buyer when we negotiate contracts. So on many of our vacation rentals, that's the approach. They, especially on properties that have been listed for 50 days, 60 days, put yourself in the shoes of the seller. You've got this $1 million home that's been sitting on the market for 60 days, and you're not hearing like the most optimistic news in the headlines every day. So you're kind of feeling that pressure to sell. So when we come in as a cash buyer on those more expensive assets, we're testing where their floor is when we're negotiating with them, because we're able to at that price point. But there are still lines of people trying to get certain $260,000 new build homes. Those are always in demand. And it's what we're trying to get, accumulate in a little bit more of an uncertain time, is strong producers. Where's there always demand? Where's there, a lot of people who are looking to get housing at $1,500 a month? Something like that is where people need to be. And there's only so many of those homes. So, it's hard to negotiate big discounts, in the same way that you would be getting on the high end of the market. So a little bit inside there, and it changes all the time, but that's where we're finding the value.
Nick, I was grabbing you another resource here to throw in. We'll get to your question in a moment here, but I wanted to go back up. There's a great question from Tim, and obviously, Cameron, we are in a place where we can't give investment advice, but we can share our perspective and like what we think and walk through the differences. So Tim asked, if you were investing in this system, what would you buy, a vacation rental or a long-term rental?
Oh, great question. Yeah, like to me, the answer is how much, like, what's the weighting that you allocate to? So it's not a binary of do you buy X or Y, but where do you feel comfortable in the allocation? And here's what each investment product delivers. With vacation rentals, you're taking bigger swings, but you may get higher returns on assets that have like a little bit more of a seasonal operating profile and a higher capital investment. And then on the long-term rental side, you get access to certain markets that vacation rentals may not work in for other markets. So like, let's take an example of Atlanta. I think that it makes a lot more sense for me to invest at long-term rentals in Atlanta than vacation rentals. Not to say a vacation rental isn't very successful there or can't work, and I'm sure we'll end up with a couple. But the point being is that there is a natural set of characteristics that come along with investing in different investment products. Like, it's not like you have the option to invest in long-term rentals in Blue Ridge Mountains. It's like there's just not a market there. So as far as picking and weighting your portfolio of, do you go short-term heavy and long-term heavy, it's like, well, ask yourself, do you want access to which markets? Well, I'm only going to find that in long-term rentals, so I'm going to allocate that to Atlanta because I want to be in Atlanta. And I can really only do that on the Arrive platform, at least through long-term rentals today. So that's how I kind of approach the decision hierarchy and like thought process of, where do you start with Arrived? It's like, well, what are my trade-offs here? And like, what do I want? Do I want an operating model? Do I want market exposure? Do I want a quicker payback? Like, what are those things that I want?
Yeah, definitely. And for me too, personally, it all goes back to like investment goals like Cameron's talking about. So let's say, for example, you're looking at the southeast corner, which could have lower appreciation, higher yields, where you would see the opposite in the Colorado. So it really depends on what you're looking for. I know for me personally, I like both asset classes. Being able to diversify and grow my portfolio within a couple of clicks is exciting to me. So to be able to say, I have shares in Sedona or Colorado or Arkansas, so on and so forth, is something that I look for. It also, with diversification, decreases that potential risk that could happen. So obviously there's always risk when you're investing for those dollars that you put in, but figuring out kind of what speaks to what your goals are overall. And Tim, congrats on selling your home in San Diego. Mike, I am not positive on the contest. If you'll let me know if you did not receive an update, would love to know. I'll share with our marketing team to follow up on that. I did see one from here, Nick and Cameron. I shared a resource on how we're acquiring properties. You're the best person to speak to this live. So how do you go out and find the properties to acquire? And do you have an acquisitions team and work with local agents?
Yes. So the latter part of the question is probably the easiest. Yes, we have an acquisitions team, and they do work with local agents. So on every transaction, we work with a local broker who serves as eyes and ears, as well as a reinforcer of best practices. And then with the acquisition team, we've got a central, well, it's centralized as a resource, but we're actually a remote company, so we're not all in the same place. But it's largely the team that I worked with at American Homes for Rent, where we're the second largest landlord of single family residential in the country. And it's a team that specializes in understanding what makes a great rental investment and income producing asset. So that's the acquisition team. And how do you go out and find the properties to acquire? So, like the factory behind the scenes is very multivariable. So there's a lot of public information that we can consume, like for listings and things like that. But there's also an entire off-market channel for what's called the wholesale market. And that is connecting sellers directly with buyers and kind of minimizing transaction costs of the transaction, and really bringing liquidity, which means just like injecting cash to help people, sell if they need to, or offload assets. And we work with that's more like partner type relationships, where you're not going to have like an open door website where you can like scan all their inventory of what they have. But as an institutional client, we would have access to an account that says like, okay, here's all of Open Doors listings that they have in progress. So it's an example of some like off market information that we consume that goes into the decision of, what do we buy? And then from there, we underwrite. So we think about this as a funnel, where the process that I just described is all these listings coming in at the top. And then we have our own way of underwriting it that combines data sources as well as like a very human touch to it as well. Necessarily you have to have systems and data to be able to parse the world of information that just like is so massive out there. But then when it comes down to, well, what really fits, then the most important is the human decision. And like from that point, it's like not system related at all, because it's all about the human looking at it. Like, is it pretty? They look on Google Maps, they kind of try to live it like somebody who's like walking up to it, right? And when it passes that smell test, from the human point of view, and the numbers match, that's when you construct the offer and kind of go into negotiation and sales tactics to get the best price. So, kind of high level overview, and then it kind of goes in standard property management process from there. But certainly can go into more detail, but that's more specific to acquisitions of like where we source.
That's a great question. Glad you asked, Nick. That resource that I shared kind of breaks it out step by step as well. And for Cameron's team and when they're acquiring. So keep us honest if there's any further clarification there. Mike, thanks for sharing. We had a couple contests, so I'll double check on the creative ideas. I will say we huddled as a team to go through these, and they were absolutely phenomenal. Cameron, that was when folks can submit ideas of what their ideal property would look like. Wild.
We actually go through those constantly as we're buying vacation rentals, saying which one can we actually put into that. So Mike, if you want to send us some follow-up information, you seem to have a lot of great questions and like seem pretty engaged. So follow up with us and have a conversation.
Feel free, Mike, to ping support at arrivedhomes.com, and I can connect you with our team too. I saw one in here from Solomon. Is the 1% rule applicable to any market in the US these days for long-term rentals?
Yeah. Oh man, great question. So the 1% rule is, just to make sure everybody's up to speed, is the idea that the ratio of your monthly rental income to the purchase price that you're acquiring for is a ratio of 1%, or 100 to 1 if you're thinking about purchase price to rent. So a real quick example of that would be if you bought a home for $100,000, but you're able to get $1,000 monthly rental rate on it. That's the rule right there. So the old school rule of thumb was like only buy income producing properties if it's meeting this threshold. Otherwise, you're not getting enough rent. And that's unfortunately just not the reality. It's like a unicorn at this point, because there is so much capital in the market, and interest rates, maybe more importantly, have just gone so low for such a long period of time that the yields demanded in the economy have just been like lower and lower and lower. So we're not finding that really any market supports that as a general rule of thumb, but the 1% rule may apply at certain price points. So let's say that you're finding assets that are $100,000. Can you find $1,000 renter? I think you can. And that's not the high end of the market by any means, but it exists. So that's actually one product that we are looking at. And it's a very defensive thesis in our mind, because it does try to prioritize a high rental rate for the investment that you're putting in. So stay tuned for that. And we're going to have like a lot of communications coming up about that segment of housing and that income profile. But it is very top of mind, Solomon. It is in the spirit of that 1% kind of getting back to strong cash flow fundamentals. In this kind of, that's what the economy necessitates.
Yeah, definitely.
But yeah, we're looking into that.
They said that will be great. Monica, thanks for the feedback there. We definitely appreciate it. Awesome questions today. I did see one in here from Mike, and I shared some details in the thread, but I always think it's good to talk about this because we can always add color, especially Cameron, because Hurricane Ian was recent. So when we're talking about insurance and protection, it's important both for our residents and for our investors. So Mike asked, what are your thoughts on asset protection, or what do you do for each of these properties in terms of asset protection?
Yeah, great. This is like a core tenet of the way the Arrived operating model structure is, like catastrophic downside protection, right? So there's a couple of buckets that I can speak to that directly address downside protection. So first one is insurance, right? And what we have is very analogous to what you would, normally think of as homeowner insurance, but there's also additional commercial coverages that you would typically not have as an owner occupant of your homestead. So we have a policy that's very landlord specific, which includes something like if you have a lease and then a natural disaster occurs, the insurance company will continue to pay us out, even though we can't get the tenant, we can't provide a lease for the tenant because the home is flooded. but they'll still pay us the rent because of the contract. So that's in a commercial protection, and there's other like liability insurance specific stuff that is really deep in the woods, but so I won't go there. But certainly we have landlord specific coverage on the down, for the downside. Next is like the debt component, because I just want to address that. It's pretty paramount with real estate investing that debt is very often a component of real estate investing. So our type of debt is non-recourse debt, in the sense that the underlying borrowing entity and its investors are not personally responsible for the repayment of the note. So yes, it's a mortgage in that the home is securitized, and that is the collateral for repayment of the note. And if you don't pay the debt, then they can take the property still. But what happened 15 years ago is that when banks took the property back, they were like, man, this is worth a lot less than what you borrowed. Even you borrowed 300 grand, and this thing's only worth 200K right now at foreclosure auction. So there was still a deficiency of 100K, and they could go after you for that, right? A deficient note. So with our debt, there's non-recourse. So it's just the property. So there's no risk of credit impact to the entity or to the underlying investors. And then, finally, we remove arrived business specific risk, in the sense that you own the assets as investors, wholly separate companies than Arrived, the company. Arrived is not a fund where we are, owning the assets and you're buying into them. They're actually on the other side of the entity spectrum layer. They're separate LLCs that you, the investors, own, but Arrived manages. So even if we were to go bellies up as a company, you still have the full value of the real estate that underlies your investment, right? So those are the kind of the three major buckets of downside protection that we've thought of. There's a lot more layers to that, but
definitely, yeah. And I just dropped a link. Obviously, I shared more details around the structure, but there is one of if Arrive stopped operating. So what Cameron was just referencing. Stephen, I think I might have missed your question here. Use same calculation, monthly income times 100.
Yeah, I think there was just clarification about the 1% rule, whether it was a monthly rent figure or an annual rent figure. So the answer is that 1% refers to the monthly. So the annual gross yield is 12%. And I think maybe it was Solomon who asked the question earlier, but he was asking about, hey, what's how much revenue do you collect and what are the net payouts and things like that? So that's what we would be talking about here, is that for a 1% rule, it would be a 12% gross yield, because it would you would collect 12% worth of your purchase price per year in rent. And that's like what the rule says, is that produces like great cash flow. And oh yeah, for sure it does, but it's hard to find in the market. Wonderful. Right now.
And Mike, I was able to just answer your question briefly, but we would assign a custodian that would make all those decisions if that circumstance did take place. So we always like to be as transparent as possible about all the different scenarios that we're working through. I did see, go ahead, Cameron.
And just I don't want to opine too much about the future, but more realistically in these situations, what happens is not that we would get chopped up and sold, not like some foreclosure auction, but rather the company would likely be acquired, and then there would be another entity stepping into absorb. So it's definitely different than kind of the image of a property getting foreclosed, or putting up the out of business sign and just leaving town. There's very much a process and kind of where capital would find opportunity, and then maybe there would be a sale. So I don't foresee a future where a transition would be super that there would be no accountability.
There's another great question from Stephen before we close our virtual doors, because we actually have another webinar kicking off in less than an hour here. So if anybody wants to hop on that one. But Stephen said, what is the current thinking on allowing investors to fund the mortgages on Arrived instead of borrowing from banks? Seems like a total winner to me.
Crowdfunded debt for sure is a tool that would be within the Arrived ecosystem. we're trying to like we're brainstorming right now about like how can we fund debt, right? And for whose debt, we're not exactly sure yet. Whether it's another consumer's debt or whether it's an arrived home's property debt, whether it's a pool, whether it's individual, that you a lot of different ways. I mean, we're even talking about HELOCs too, like a concept of a HELOC that you could borrow against your shares, right? And it's kind of a pass-through HELOC in a way. So all of this is on the table for us. So Stephen, we're definitely thinking about it. And more than just thinking about it, we're like putting regulatory plans to structuring them so that way they can actually happen.
And Mike was referencing about when we're talking about protection and liability and all those different things. So it's not dark in any way, shape, or form. We appreciate the due diligence. It's the reason why we do these webinars. We're building for and by you, whether that's feedback or more transparency. So definitely keep it coming. Stephen said great, so appreciate the feedback there. I'll give it a few more seconds if we missed any questions. But before that, Cameron, you finished a Waterloo in one webinar today.
Yeah, it's on. Right? These questions were so good.
But a ton of great engagement today. It always makes this way more fun. So, Cameron, any closing remarks before we shut our virtual doors and then open them back up soon?
Yeah, like in my role, I'm always wanting to make sure that we're providing great investment opportunities, right? Because we're essentially finding them and sourcing them. So I look for feedback from you all, and your great questions are always appreciated because like a lot of things are validated on these webinars. So definitely appreciate
Jim, thank you for the positive feedback. We will see you next time. Tim, great questions today. We so appreciate you coming. I know there was a couple mics in here, but Mike, if you want us to follow up in any way or connect, definitely let us know. support@arrivedhomes.com for anybody on the line. I'm trying to think if I'm missing anything. I will mention we are working on providing webinars, obviously, that touch on different things that are important to you. So if there's a topic that you would like to see, please let us know, either in the chat today. Feel free to drop it while we're closing up here, or email me as well. We want to be providing you as much value as possible, whether that's on a product roadmap. I know we have one next week, Cameron, on our Q3 performance as a whole, which Cameron will be on, and then our business operations manager, Jake, who I know you all have seen. But we would love to hear from you on what you would like to see as we're building for and by you. So thank you, everybody, for taking the time today to walk through our 6 new properties. And I know some of you will catch you in an hour or so, but I hope you all have a great rest of your day. Bye, all.
All right. Thank you all so much.